Hey, everybody, it's Jeff here once again with the Money Trekker podcast, and it is a Financial Friday with Tom Kemler. So really excited to have Tom on today. We're going to have several things on here. We're again getting mixed economic numbers coming in, which that always causes a little bit of concern when we've been on this nonstop tear of really great economic numbers. So we're starting to see some mixed numbers there. We're going to hear a little bit about some stuff Tom read from Ed Yardeni, who's a real famous economist and money manager that's been around a long time. And in addition to that, our most interesting thing, and this week will be a little bit different because Tom couldn't find one most interesting thing, but we have a bunch of different contenders. So hang on, we'll be right back on in just a second. Hey, everybody. Thanks for joining us for the Money Trekker podcast. Today is Financial Friday with Tom Kemler of BK Wealth Consulting. Tom, how are you doing, my friend?
Tremendous, Jeff. How are you?
Fantastic. Glad to have you on here. I'm looking forward to hearing all the good stuff that you've got for us today. What do we want to kick off with?
Well, we'll start with the economics,
Okay.
And then just kind of proceed from there. It's kind of the way. Sounds highfalutin, but that's the way the markets do it. So, actually, we'll go ahead, and here we are. I blew this up so that we can.
It's back.
This is our logo. So hopefully somebody's going to come into our theater, but
the inconvenient truth side instead of the reassuring lies.
That's us. Everybody's going next door. Come on over, everyone, to our side. So anyway, we had a couple mixed, as you mentioned, a couple of mixed indicators this week, and less. So regular viewers will maybe be a little bit pleased that we won't have so many to scream through. Only about 4 this week.
Okay.
Leading economic indicators were up strongly for April. This followed kind of the thing that we've seen with a lot of positive deals, is that the prior number was strong, was expected to moderate a little bit, instead came in above it at 1.6%. This is month over month, by the way. So these are numbers that are typically around 1 or 0.2%, and you compound it over a year, and you get about 2% for a whole year.
Yeah,
a 1.3% and a 1.6% month over month. I mean, you straight line that out, and it's about 16%, which is just enormous. We're not going to do that, but PMI number was huge. Now, this is a flash number. The Purchasing Managers Index is PMI, and this is the May number. Now, what they do is they only have one number a month, technically, but what they'll do is they'll flash a number halfway through the month, and then they'll have a final number a couple of weeks after that. So you really get 2 readings. The reason I usually don't include the flash because it's not as robust, but and usually it doesn't have this kind of difference. I mean, this is what stood out to me is the prior numbers, which folks will recall that this is a diffusion index with 50 being the above or below water. So anything above 60 is already strong, and these numbers were gigantic and really came in boldly. I mean, the services index at over 70. I'm sure it's been out there. I haven't seen a number over 70 ever. I'll have to look that up to see if it's actually been, when that happened before. Maybe it has. I just never saw it. Really strong.
Mhm.
So that's the two positives. The negatives, the Philly Fed, and this is negative. We've highlighted the Philly Fed past several months, and it had a couple of numbers that had never been higher when it got into the 50s. It was supposed to kind of hang there. Instead, it dropped below the consensus and below the consensus range. Now, that being said, 31 and a half is still giant, because this is a diffusion index where the water level is 0. So,
Okay.
anything 31 is still, enormous, but it's
Yeah.
just, it's cooling off a little faster than they thought. And this is a little more troubling. The existing home sales number came in. This is now 4 months in a row. I think 4. I think this is April. I think. Well, whatever. I mean, you can see the year-over-year number is still enormous. Over 34%. But for the month-over-month, it's been somewhat negative for, I'm going to say, 4 months in a row. I think this is April. I think all of 2021 has been, and so the pace, while it's cooling off from the highs, it's still well above last year. But the real locomotive that's pulling the train of our economy has been the real estate market, and so there's been some concern that if this slows down, it's really going to be a problem for all of the myriad of industries that are suppliers and vendors into construction and home sales and everything else, furniture or what have you. So I don't think it's panic time, because it's cooling off. And one of the reasons why they claimed that this number was a little bit weaker was because of rising mortgage rates. But that appears to be unwinding, and that's something we'll talk about a little bit later on when we get to the most interesting thing.
Well, it's interesting, because we always use Jeff's gut check index, and I'm just driving around my neighborhood. There's probably 10 houses in my neighborhood that have been up for sale now for at least 3 to 4 weeks and haven't sold. So, I think we're reaching that peak of price in our market where, people had been getting, hundreds of $1,000s over list or over what they're putting them out on the market. And I just don't think that's happening anymore. So.
Yeah. As you teased a little earlier, this is from Yardeni.com, Ed Yardeni's group, and what he's doing is he's using the Citigroup Economic Surprise Index, and this is an index that they've been creating for this. This is the last 12 years or so, but it actually goes back about 20 years. And so this Citigroup does on a very minute level, very comprehensive level, what we've been doing kind of ad hoc this year, which is presenting all of the economic reports that are surprises.
Sure.
They have, I'm sure, a whole team, and they've probably got bots that are crawling through all of the internet and finding all of these various economic reports. We only concentrate on the biggest ones, but the interesting thing here is, so the zero line shows where anything above the zero line is that there are more positive surprises than negatives and what have you. But so you can see here, we were doing pretty well early in 2020. The blue here is where we just got into 2020. Things were going fine. And then, of course, you see COVID and, the COVID cliff, and we dropped down. And then when you and I started, I believe it was in April of last year, we were already starting to see this move off the bottom, and this is what we were reporting on for many months. And then to me, it's interesting to see that the peak in positive surprises was much higher than the trough in negative surprises. And that's a little bit at odds with a lot of other graphs that we've seen where COVID had there was the COVID waterfall down, and then even though there's been a steep uptrend, it hasn't quite taken us to the level where we were before. And this one obviously the magnitude was higher, and it held up for longer too. But slowly we got back down in by, this looks like probably October or so of 2020, where we started to we had drifted back to the highs for the last decade, which is still pretty strong. And then we spent several months in there. And then now we've been taking these legs downward. And this last few weeks is what we've seen here. And this is really what we've been talking about now for, I think, 3 weeks, maybe 4 in a row, is that we're seeing, as many negatives as positives. And so as of today, I think this number is actually not zero. I think it was negative 0.1. But for all intents and purposes, we're back to where the surprises are about equal to the positives are equal to the negatives. So what does this mean? Well, what Yardeni's done is he doesn't work at Citigroup. He's taking their data, and then what he's done is lays on top of it. Now this looks like, a polygraph test or or an electric shock therapy, EKG, something. But what he's done is he's laid this, and he goes back to 2003, and the surprise index is here in red, and then he's overlaid the 10-year Treasury yield in terms of a 13-week rate of change in basis points. Now, what does that all mean? The 10-year Treasury yield is X, but then people care about, well, is that going up or down? And he's found a 13-week rate of change, which is 13 weeks is a quarter of the year. So, basically over the last 90 days, has the 13 has the change in yields of 10-year treasuries been in terms of basis points? And just for to get everybody on the same page, what's a basis point? Well, when you hear, something like the treasury yield today, 10-year yield is 1.63. A basis point is the 0.63, and they just represent that as 63 basis points. So that's all the nomenclature. The easier method or easier conclusion that you can get from looking at all this is that the surprise index and treasury yields tend to track each other pretty closely.
Yeah.
I mean, this is almost 20 years worth of data, and basically, if the surprises are positive, then yields are rising, and yields would be rising because the economic activity is increasing, and it's finding its way into increasing treasury bond yields, and vice versa. So the implications here are that we were seeing treasury yields rise, but with this waterfall down back towards even, that we've seen treasury yields have moderated in the past several weeks, really going on about 2 months now. We had that spike up to about 1.75% that scared the markets back in March, and we're not there. And so even though we're seeing all these inflationary reports, the PPI and the CPI, we're not seeing the treasury market, we're not seeing yields continue to increase. All of the issuance in terms of deficit spending and additional bond supply put out there is not creating additional pressures to the upside. And this is a pretty good reason why. So this shows how susceptible the treasury market is to real economic activity. And
Well, and I mean, yeah, just from a chartist point of view, you look at that and you say, it doesn't look like there's really been a history of that thing just bouncing on a support level of zero. It tends to blow through to the other side, which would say that that's probably going to drag, interest rates back down. It doesn't just stop there. It tends to go down below and then come back up again. And
yeah, I mean, it's tough with where we are right now. But yeah, I mean,
yeah,
the flip side to this is that it's not like watching a trend that lasts forever. I mean, this thing has oscillated quite a bit. It's back and forth across the zero line, many times, and it can do it many times within a year.
mhm.
Even within 2020, I mean, that it crossed over pretty quickly. But anyway, I just thought people would appreciate seeing that from a perspective of the way we've been looking at things. This is a much more comprehensive and quantified look at it. So. Next, we have the most interesting things, which are, as you kind of tease, I couldn't come up with one this week. So I came up with several things that I thought were interesting. The Archegos hit, that was the most interesting thing several weeks ago, and we talked about how
the gift that keeps on giving.
Yeah, well, what happened here, and this is real world implications. So Credit Suisse, they were the biggest loan originator to creditor to Archegos, and unlike J.P. Morgan and Goldman Sachs, they acted the slowest when it was obvious that they didn't have the money. So they took the biggest hit, 5.5 billion, and they ended up firing the two most senior executives just below the CEO involved in the business. And but they had to raise fresh capital, they had to cut their dividend, and they had to cut bonuses. And so what's the real world implications of that? Well, they've got some talent that just says, hey, I'm going to hit the road. You knuckleheads basically cost me money, and I don't want to work here anymore. And so, these are some big hitters. This was from where the Archegos hit was it within the prime banking relationship that Credit Suisse had with the hedge fund Archegos. And this is a separate part of the bank. This is investment banking. So, it shows where you're a big bank, you can have these big units that can be profit centers in and of themselves, but they can also be loss centers. And the prime brokerage business sapped the whole everything, and it's going to really be a problem for them in investment banking. And it's going to be interesting to see if how many people they lose and whether or not they're going to be competitive for a while.
Yeah.
Real estate, you were talking about this. I put this on because this was a picture that was taken. This is on the Wall Street Journal. This was an article that was on there Wednesday, I believe. This is a picture from just outside of Allentown, Pennsylvania. And I actually lived in Allentown, Pennsylvania for a couple of years in the mid 80s. And I can tell you that they've never had a real estate boom up there like they've had now. So I thought it was interesting. Now, you've mentioned it may be cooling off a little bit in your neck of the woods, but folks here in the Allentown area, they're not used to this. And so I came home crying. It was a buyer who I had reported going to at least 2 dozen open houses, and each time they've been stymied when they submit a bid. But
Did you see the article this morning about Bentonville, Arkansas? They're actually paying people $10,000 to move there and giving them a free bike.
wow, that's Walmart's headquarters.
It is Walmart's headquarters. I'm like,
I would have.
the only problem is, I'm like, that is the single most expensive airport to fly into on the planet, because the airlines know they can stick it to the
It's all
the vendors
people going in to do business with Walmart.
There's no other reason to go there.
I was up there once. We went up to the Ozarks and did some tooling around there a number of years ago for a vacation. It was pretty cool. I mean, I like the area, and it was, but it's kind of remote. It's pretty far away from, other population centers. But the Bentonville area, there's like 3 other towns there. There's a pretty big, overall metro area is pretty big. I don't know why they would have to pay people to move there, because it was big and growing.
I don't know. I don't get it. They feel like it largely was mostly people working for Walmart that live in the town. So what they're trying to do is encourage people to move there and start businesses and kind of diversify their economy. That was the reasoning behind it. But I mean, it's a cool little town. I mean, Bentonville's nice. I mean, Fayetteville, where I used to have to go to, that was awful. But
University of Arkansas.
University of Arkansas, I used to have to go up there all the time. So we actually, when I worked for another company, they required us, because it cost so much to fly into Bentonville, that we used to have to fly into Tulsa and then drive in from Tulsa every time.
That's a drive.
Yeah.
It's not close. Wow.
It is not. Yeah, it is not at all.
Wow. Anyway, they're having a boom. The boom is extended. The real estate boom is pervasive if it's in Allentown.
If
First of all, I would
never
never wait this long in line for food if I was starving. I certainly wouldn't wait in line to go into a house
and stroke a check for $100,000 over the asking price. It's insane.
This is peak.
Yeah.
Shipping can't have enough shipping. But the interesting thing is, for those people who remember The Big Short, which was a book that was written about the great financial crisis, and the actual investor who made his chops was a guy, Dr. Burry, and Dr. Burry made a lot of money for himself, but then he formed Scion Investment Management, and now he's an investment manager. And as such, last week was the quarterly filings for investment managers and what they're buying and selling. And his was some of the I always keep an eye on that, because you have to know what the big boys are doing and the smart guys. And sometimes, even you look at Buffett, there's always changes, but, his core stays pretty much the same. He might add here a little bit. So it's kind of interesting to see when an investor completely changes their portfolio. And Dr. Burry and Scion did just that in the first quarter, and he got into shipping in a big way. So he's a smart guy who saw the great financial crisis coming down the road, and he obviously believes that shipping is and the bottlenecks that we've been documenting in shipping are here for at least a while. And that's all I'll talk about shipping this week, Jeff.
It's all right. It's totally fine.
The number of states that have dropped the enhanced federal unemployment benefits because of COVID is now 22. These are, without exception, these are all states with Republican governors and or Republican houses of legislative control. I guess I can't say Congress, but legislatures. So anyway, it's getting on towards half, and it was only a couple of weeks ago that I think Montana was the first to opt out. And now it's up to 22. So and then finally we've got coronavirus cases.
That's
we haven't talked about this in a while, but I think it's interesting to show that this number is now the 7-day moving average, which is this blue line, is now under 30,000, and it's the lowest it's been since back here in June. So 11 months. These are the new cases per day. Deaths is a similar story. So you got to go back to July here to be lower than that. This is the COVID-19 vaccine 7-day moving average. And what I found interesting about this is that in early April was the peak of how many on a 7-day average we were doing, and we've been basically declining ever since. So there's talk now about how many doses we're going to give to other countries, and I think the administration has already decided we could ship out 20 million, but it's not like, we're still doing about 1.75 million a day, but it's been a steady decline for a month and a half.
Yeah.
And and part of that is that people are fully vaccinated, and the number of people that want to get vaccinated and haven't been is continuing to shrink. So
it's just now I'm seeing signs. I remember you couldn't find a place back when we all got our shots, and now I was driving past Williamson County's the little tax office, and they had a sign up front: "We have Moderna vaccines for free. Come on in here."
Well, there's also, I don't know who would, I read an article in the Journal this week about a guy, pizzerias. I mean, they're in restaurants and stuff. I mean, they were giving away free pizza. I didn't get anything free.
I didn't either.
I got the shot for free, but
I got freedom, dude. I just went to a Buc-ee's that had like 400 people in it coming back from Houston, and I got to walk around there with no mask on. It was awesome. So.
Oh, did you go to the Buc-ee's in Bastrop?
Yep.
Yeah.
Bastrop Buc-ee's, bud. I mean,
it's on the right there. So as you were coming back, getting on 71.
It was genius. I mean, even walking to the front door, and I'm like holding it right to my face. Okay, wait a minute. Oh, I don't have to.
No.
And nobody looked at me funny. It's awesome.
I don't think Buc-ee's. No, I mean. I don't know. I think there were a lot of people that weren't wearing masks at Buc-ee's the whole time.
I don't think they cared, because they're like, just bring your money and we're good. So
for everybody who is listening that's not from Texas
and doesn't understand what the hell we're talking about,
Buc-ee's is just a force of nature. And I will go out of my way if I have a choice in routes where I'm driving and I know there's a Buc-ee's on one way and there's not on the other. I don't care. I will go the way the Buc-ee's is.
Yes, and for those of you that don't understand, it is the world's largest gas station / food place / gift place / everything else. It just has everything there, and these places are massive.
Yeah, it's a convenience store that's as big as a Walmart.
Yeah.
With 100+ pumps out front.
Yep. Yep. And cars.
And the best part about it is that they have the pumps are not only number in the hundreds, but they're so far apart that you can have two people at pumps at underneath of in one bay, so to speak, and it's still wide enough that you can drive your car through the middle.
Yep.
So there's room for so many vehicles.
It's room for you to get your barbecue on too. So
that's good barbecue.
Well, awesome.
Anyway, that's what I've got this week.
Love it.
Love it. And a lot of these themes showed up in the Fed's beige book this week, which has been given. The market has been doing some of the same things. We've had some choppiness. We've had some sideways action. One day we're up, the next day we're down. This all gets back to what I've been saying is that I believe the markets. For all those people who want to say, oh, the markets anticipate, I don't think they're any better than knowing the future than the rest of us, because, we're all human and we don't know what's going to happen in the future. Right. And so they tend to be reactive. And the key is finding the things that they react to. And that's what we have been attempting to do on this show. And I think we're doing it. So
and a pretty dang good job of it too. So
that's where we are.
Awesome.
And it's 50-50. Basically go back to here. We're right here.
Yeah.
Not positive, not negative.
Yeah. Right. Somewhere in there. So well, good.
Anyway, that is what I've got for this week. We could have probably talked about Buc-ee's as the most interesting thing, but
it probably was the most interesting. Well,
don't get me started on Buc-ee.
Here's why it was the most interesting thing today. What difference does a year make? That place was packed. There was probably 400 cars in the parking lot, and the roads were packed and everything else. So that tells me that finally people are out and about and excited, and there's tons of people traveling and tons of people going to the lakes and everything else. So that it says that we're coming out of this and coming out of it with a gangbuster. So
tremendous. Love hearing it.
Yeah, I do too, except for the traffic coming back from Houston. But other than that, it was great.
Yeah.
All right, my friend. Well, thank you so much for doing all this today. Great stuff. Folks, as always, make sure you subscribe to the channel, whether it's on YouTube or any of the podcast channels we're on, so that you get these as they come out. We are now up to the point where we're consistently doing 3 of these a week. I'm trying to do 1 entrepreneur interview a week, 1 expert interview, and then our Financial Fridays. So we're going to keep up that pace going forward. So very excited to have y'all on board and listening. Please feel free to comment and give us a good rating. And with that, Tom and I will be back here next Friday, and I will see y'all back on Monday with an entrepreneur interview. And it's a great one with my friend John Galavis, who is an entrepreneur who just really was able to adjust and fly his business during COVID. So it's a really interesting interview, and I encourage you guys to watch for that on Monday. So thanks a lot. We'll see you guys back here next week.